Hello there, my friends. Chris Marcus here for the StockPulse Network on Friday, October 12th. And I'm excited today to have a guest that I've been reading some of his work and following for a couple months now. We have Stefan Kremeth from the Incrementum Fund, which is based in Liechtenstein. Stefan is actually calling in from Switzerland tonight. So it's exciting to get some perspective on the markets from a non-US centric view. And with that said, Stefan, it's great to have you here. I know you've been covering the markets, and just before we dig in, how are you doing over there today, my friend?
Hi, Chris. Thank you very much for having me. I'm very well. It's dark outside already here, and the Swiss national team is playing against Belgium tonight, so we have to cut it short tonight. I'm sorry, but I'm very happy to be on the show. I'm very happy to answer your questions. And I think you should shoot.
Yeah. I imagine the Belgium team is a little tougher than beating up on the U.S. here. So, with that said, obviously it was an exciting week in the markets. Well, exciting or painful, depending on one's positioning. But let's dig in. And any thoughts you have? Certainly, the U.S. stock markets were down. That did spread around the globe. And would love to know what you're seeing and your take on the action that happened this week.
Okay, the markets were down quite a bit over here. The Swiss market index is down almost 8%. The Stocks 50 is down, I don't know, some 8-9%. DAX down 10%. So we see markets that were not very cool. It didn't start well already last Friday when we had the first sort of slump, and then it just went through the whole week. What were the reasons? I think there is multiple reasons. First of all, there is this global economic tension between I think, political leaders, we could call them, but also between their sidekicks. And I think that definitely doesn't help. Then, of course, there is this big fear of raising interest rates, especially in the US, of course. But so far, we cannot see that in Switzerland at all. We cannot really see it in Europe. Switzerland tonight or today announced, the Swiss National Bank announced that they're going to stay negative. So we're still at 0.75 minus. So you give your money to the bank and you don't get anything. They take money from you.
Yep.
Which is amazing. Some sort of hidden tax, I would call it. So I don't think there is something gonna be changed soon. At least not in Switzerland, and I don't think there's something going to be changed in Europe either for the next at least 6 months, 9 months, 12 months, maybe even. US is a slightly different situation.
Well, in some ways, not entirely different. It was funny. I wrote an article a couple of months ago because I noticed there was one of the Fed officials was actually even talking about advocating negative rates here in the US. Obviously, in Europe, my guess is if you had an accurate inflation metric in Japan would be similar. So it's certainly a fascinating environment where, like you said, you put $100 in the bank, and if they're still there next year, you get 99 or 98. And I'm curious in terms of how you're looking at the markets and positioning and advising clients, what do you say when we have an environment like that where many places around the globe you are getting a negative interest rate? How do you respond to that?
Look, our business model is as such that we offer investment advice, or actually we manage private clients' money on one side. We manage and co-manage a few investment funds. And on top of that, we produce research. When it comes to managing private clients' money, what I see most and what I receive as answers or request most is to get some sort of investment return.
Right.
So what we are doing there is we put together a diversified portfolio, mainly based on equities. We only invest in stocks of companies that produce net free cash flows is their intrinsic business. So that means that if you have a company XYZ producing, let's say, razor blades, but that business is, let's say, not profitable, but they have a side business, which is real estate, because they have accumulated that over the last 100 years. They're making a hell of a lot of money with the real estate, subsidizing the razor blade business. We would not invest in it because the intrinsic business of the company would be the razor blades. And that has to be able to produce net free cash flows in, I would say, 4 out of 5 years. So there is always a possibility that for whatever reason, you have a slump in 1 year. That's okay. That's fine for us. But we want the companies to produce net free cash flows over the cycle on a regular basis. And on top of that, we want the company to share those cash flows with their investors in form of dividend, capital reductions, whatever, free options, something like this. And then what the client gets out of this, you know, in a diversified portfolio, you have some volatility within the equities, obviously. You can't take that out unless you pay for it, you know, by hatching it. But that the hatches usually, they cost a lot of money. So you have the volatility, you accept the volatility, but in return you get a reasonably stable cash flow.
Right.
And cash flows in our portfolios, they're unbelievably stable. So even during the financial crisis, great financial crisis 10 years ago, the cash flows were stable. We had a huge, enormous volatility in the portfolios, but the cash flows out of the portfolios were extremely stable and then slightly increasing after the great financial crisis. And that is the sort of product we offer to private clients. Now, everyone understands that when you tell them, you know, and you tell them, look, don't look at the portfolio too much because it may go up, it may go down, okay? The cash flow is important. And they will say, yeah, no problem. But then on days like today, I mean, today actually was better, but during a week like the week we just saw, investors still get nervous. And I understand there's a lot of psychology behind it. There's a lot of media, you know, publishing terrible reports and everything. I understand they get nervous. But if they stick to the portfolio in the long run, I think they're going to be okay, frankly speaking. And then we always add a bit of gold or precious metals, depending what the client wants and how he actually perceives precious metals. We add that as a sort of an insurance policy against, you know, like situations we had the last few days. And again, gold went up while the markets went down. So it took some of the volatility out of the portfolios, which for the clients is perfect.
Yeah, which is especially now, you know, here living in the US where all we hear about is Amazon or Facebook or a lot of tech ideas, which may well pan out, although I think it's something that's been lost in the US. And I really appreciate you mentioning how there's also some value in when the company is actually making money and does have cash flows and is giving dividends so that you can hedge some of that volatility and not just be at the whim of, you know, some of the short-term trading that goes on certainly here in the US and can move the markets. And before we started recording today, you did, and you just touched on a little bit, but I thought you had a good perspective, especially for people who fall into the gold and silver bug camp like myself, but you had some really good thoughts to share of really how to put that in perspective and an appropriate role that could play in the portfolio. So perhaps you could touch on that a little bit more, because I think that's really relevant advice to folks who get into gold and silver, and if you could share really how's maybe a good way of looking at that.
Yes, I'm very happy to share my thoughts there. First of all, we are not speculators, okay? We are in it for the very long term. So, you know, I don't look at weekly, monthly performances. I don't care. I strictly don't care. I want to have regular cash flows in the long run. So that's what I'm looking for. And same is true, obviously, for precious metals. But I think there is a bit of a misconception there. People buy gold and they believe they will be rich within 2 months. This is just not going to happen. I mean, gold is something that can preserve value in the very long term, extremely long term. Look at the cycles. You have, of course, some short-term volatility, normal, as you have in many asset classes. But gold is, for me, something to store value very long term and to protect you if there is a systemic risk approaching. But gold itself is not going to make you rich unless everything else is going down the drain.
Right.
You need some sort, economically, you need some productivity factor in order to create money. And if you just hold gold, physical gold, you don't have that. You know, if you buy a gold miner, that's something else. You know, you have a company that is productive, that does something. It could as well be a miner for whatever. In that case, it's a gold miner, and that's something else. So they are actually generating cash flows. But the gold bar itself is not. It's an insurance policy. It's a possibility to store value very long term. And I personally believe it's something great to have. And it's if you have it in smaller denominations like coins and so, it's fantastic presents for your children, for your grandchildren, whatever. I love it. It's great. But again, it's not going to make you rich.
Yeah. Well, I think one of the things, especially here, that have attracted people to gold and silver is watching a lot of the money printing. We talked a bit about the negative interest rates. So I'm curious, especially your perspective. Again, I find I actually lived outside of the US for a year and a half, and it's interesting seeing an international perspective. What is your take on the Fed? Obviously, they've been raising interest rates here in the US, very, very slowly unwinding their balance sheet of quantitative easing purchases. Curious, any thoughts on that, perhaps, where you think they might do going forward, or any general thoughts on the Federal Reserve and their very expansionary policy that they're trying to unwind now?
First of all, I must say, in 2008, when everything happened and the Federal Reserve, you know, Hank Paulson and Ben Bernanke started to print, you know, like crazy.
Yep.
We were all, you know, thinking that this can't go, you know, can't lead anywhere positive. Yep. Now, retrospectively, frankly speaking, I think it probably, I mean, there was a lot of misallocation of capital and so, all clear. But it probably prevented a much bigger crisis. Now, the question, of course, is, and that's what a lot of people are actually even banking on, is if this was only postponed into the future, so that we're going to have an even bigger financial crisis, possible. Or if there is some way of getting out of this without getting hurt too much.
Right.
And I'm a positive thinking man, you know. I want to believe that we get somehow out of this without getting into very deep trouble, you know.
Yep.
And if we don't, I still keep some precious metals,
yep.
You know? And I have a huge wine cellar, and so I have a few bottles of wine. If we have a big crisis, I'm not going to be, you know, short of wine at least. You see, so I have gold, silver, and wine, which wine maybe is also a currency if necessary. No, what I want to say, this of course is a joke. What I want to say is, I don't hope for a big crisis, but if there is one, I think it's wise to get some sort of protection. And to our private clients, the first advice I always give is own your own property. Have your own house, your own apartment, and try to not to leverage it too much, or even try to have no mortgage on it over time. You know, most people just can't go there and buy a house. But then reduce your mortgage as much as possible so that you're independent. So if you have achieved that, try to get other, sort of protection with gold, silver, whatever it needs. And then the rest of your money, I think you should invest in equities. The equities on the very long run have proven to be, even if they are very volatile, have proven to be quite resistant to extreme shocks even. I mean, great financial crisis was quite a shock. And still, if you had a good cash flow producing, solid businesses, and you had equities of those, you're probably even at higher prices today than before the great financial crisis. So I think it's a mix. We're looking at the markets, and we approach the market with a toolbox. So it's different tools for different sort of situations and for different sort of people also, because not all the people have the same needs and wish for the same sort of investment tools.
Yeah, and I think it's great advice because, again, and certainly I'm guilty of this, going maybe overboard on the metals at times, watching the Fed and following them every day pushes me into that. But again, that's why it's great to have you on here and really talk about some of the ways that you can diversify your portfolio and not leave everything counting on whether it's metals or any particular asset, but finding businesses that are producing cash flows, which, like you said, is nice because you can take yourself away from the day-to-day price fluctuations a bit and know that you have a solidly constructed portfolio. So really just the last question is if you could let folks know how they could find you, certainly if they are interested in investing or have any questions. Stefan also did just, along with Incrementum, put out a great research report on the crypto sector, which I read last night and found really helpful. So if you could just share how people might be able to get a copy of that and get in touch with you if they'd like to follow up.
Absolutely. I'm happy if you join our readers, and you can find us through our website, which is www.incrementum.li, incrementum, like the Latin word for intrinsic growth or whatever. And you find us there. You go to all the stuff we publish, and when you press on them, you can choose whatever you want. It's all free. The only thing you have to do is you have to leave your email address, and I'm not even sure, maybe your name. Because of data protection law and stuff like this, today this is very difficult. Unfortunately, we have to get data from the people. Right. It's not that we wanted that, but we need to get it. We had to introduce that.
Well, all I can say is that I was happy to put my name and email in there. I really like your newsletter. Again, one of the things that someone who's always trying to learn more about the markets I appreciate is when you have a nice calm approach, and it's also very educational, not telling people what to do, but introducing some ideas which I've found very valid. And with that said, it's been a pleasure to have you on the show. We'll leave that link below, and best of luck with the soccer game tonight. I know it's late there, but again, do appreciate, I think you shared some good information. So thanks again for coming on.
Thanks a lot, Chris. Thanks for having me, and have a very good weekend.
All right. We will talk to you again soon.